Bad credit car finance. What is a subprime car loan and should you consider one? With the car industry's use of bad credit car finance products under investigation by the FCA, we look at the pitfalls. Subprime is a word most would associate with the housing crisis of 2008, but recent months have seen it increasingly connected to the automotive finance sector. The Financial Conduct Authority in April announced it would investigate irresponsible lenders and lending practices after it raised concerns about the quality of car finance provision across the UK. The watchdog is particularly concerned over subprime or bad credit finance, where car loans are given to customers without the proper checks that they can afford to repay them. The lenders under scrutiny are likely to include a number of specialist subprime car finance companies which are notorious for taking on buyers with bad credit histories and charging them higher than normal interest rates. These kind of car loans have increased in the UK as the car market has become more and more addicted to personal contract purchase, PCP, finance deals that can secure customers a new car for a limited deposit and low monthly payments. But how does the bad credit car finance industry work? What are its dangers? And what are some of the things to check before signing on the dotted line for that car loan? We've put together the following tips and advice to help you understand the pitfalls of subprime car finance. What is a subprime or bad credit car loan? A subprime loan is simply a loan made by a lender to a party who may have more difficulty maintaining the repayment schedule than the average car buyer. In car finance, there's not a single cut-off point that means a buyer suddenly becomes subprime. And while there are specific subprime car finance providers, subprime loans can also be obtained through mainstream lenders. There are several factors that could lead to a borrower being considered subprime by a lender. These include a lack of credit history, previous and excessive debt, previous failures to pay debt, bankruptcy, and other caveats corrosive to a person's credit score. Any one or combination of these factors could lead to someone being refused car finance, and as avenues to finance a new car close off, buyers can be funneled towards finance deals and lenders designed to cater for subprime customers. To make up for the added risk, finance providers will usually add higher interest rates to their bad credit car loans. Lenders are known regularly to charge APR rates as high as 42.9% to make up for the higher risk, a stark contrast to the 0% or APR finance rates quoted by many car manufacturers and mainstream lenders. Subprime car loans may also come with other additional fees, while some will have adjustable interest rates, meaning that the interest you pay on the loan isn't fixed, but varies according to the market. This kind of deal can become very costly in the long run. In either case, a subprime car loan will mean that as a buyer you are very likely to end up paying more over the course of the loan period to make up for the greater risk the lender is taking on. What is dangerous about subprime loans? The 2008 financial crisis was started by risk-taking lenders handing out subprime loans to homeowners who couldn't pay back their mortgages. Banks then bundled these loans together and sold them as assets around the world. As owners began to default on their loans, the assets turned sour and the market collapsed. Although car finance loans have been placed into similar bundles, the Bank of England has said the risk of a crash is not as great as with the housing market. Instead, the risk with bad credit car loans is twofold. First, it's with the car buyers. If they've been sold finance which they either do not understand or cannot afford in the long run, they may risk defaulting on the load. Falling behind on payments could lead to the car being repossessed, will hurt your credit score further and could lead to you being declined finance altogether. This is the primary concern of the FCA's current investigation. Have the terms and conditions of the loan been properly explained to the customer, and has the lender taken enough precautions to make sure the borrower is able to pay back their car loan? The second risk is to the car market in general. If a large economic shock were to take place where borrowers suddenly find themselves unable to pay their loans, car manufacturers and dealers could see major falls in revenue. Forecourts could fill with more used cars, driving down prices and damaging the car market as a whole. The Bank of England has already raised concerns about the growing reliance on finance. A blog by an economist at the Bank of England said, the industry's growing reliance on PCP has made it more vulnerable to macroeconomic downturns. Should you avoid subprime car finance? Not necessarily. If your credit score isn't very high for any particular reason, but you have the finances to pay back the loan, then there is nothing wrong with a subprime car loan. All it means is that you are probably going to pay more in interest and fees than a borrower able to buy from a dealer or lender offering standard car finance deals. However, there are major pitfalls that one can easily fall into in the rush to get a new car on your driveway. It's imperative that before you sign on the dotted line you understand all of the terms and conditions of the agreement, and more importantly are able to adhere to them. Don't take out a finance deal that you can't afford to pay back, and that means understanding exactly what the agreement is going to cost you over its entire term.